My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Kramer. Welcome to Mad Money. Welcome to Kramer. My friends, I'm just trying to make a little money. My job, not just entertain, but put all this in perspective. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Look, everybody knows I get up real early, right? 3:30 is my target time. Now, some of that's to do work. Some of it's to get the zeitgeist of the day. And most important, a lot of it's for the top 10 things to watch memo I write every day for Investing Club members. That's where I highlight what the big shots are thinking when it comes to the mountain of research I get every day. And in the absence of earnings, it's that mountain of research that matters. You see, the season isn't going to get rolling until Friday. I like to peer at multiple pushes, multiple upgrades, and price target hikes, because right now, in the absence of earnings, they often determine the action of days like today, where the Dow ultimately dipped 53 points, S&P inched up 0.07%, NASDAQ advanced 0.14%. See, like so many other days lately, most of the big calls were about the sainted stocks that we talk about all the time. The Apples, the Lillys, the Nvidias, the Microsofts, and they're all positive. And you know what? I don't know whether you can really understand this. Most of the time, these research recommendations are working. They have the intended effect. They're moving stocks higher. The endless buy recommendations for the tech titans are really the major reason why we keep getting these new records, both in the market and individual stocks. It is a chief reason why the tech tone is so darn great so many days of the week. The cheerleading, it is impactful. The stocks, they continue to roar. So let's review just one day. One day's bounty. So you know why stocks just keep working their way higher. It's been a couple of days since Nvidia has had any champions. But today, the analysts ran a full-court press against any remaining skeptics. Yep. An analyst at KeyBank raised his price target from 130 to 180, talking about how the demand for Nvidia's new platforms is extraordinary. And by extraordinary, I mean insane. It's the Blackwell formulation. These chips and their accompanying systems have turned out to be even more popular than we expected when Nvidia first rolled them out at the GTC conference, the big trade fair that I went to earlier this year, where I couldn't have been more bullish. I wasn't bullish enough. Now, plenty of people wonder if Blackwell could cause a major problem for Nvidia, because if the new chips are so powerful, why would you ever go buy the current iterations when you just wait for Blackwell to ship volume in the fall? But just as the amazing CFO Colette Kress told us repeatedly, there are no transition worries. The current iterations from NVIDIA work well with Blackwell. So there's been this continual ordering right into the Blackwell cycle. Positive, virtuous demand for Blackwell, which allows generative AI to be fed not just text, but video, is so strong that you have to wonder if it will be far bigger than initially thought. It doesn't hurt, by the way, that Blackwell's more of a software platform than just a chip inserted into some sort of ecosystem, not of NVIDIA's own. NVIDIA makes the chip and the ecosystem. And you know what that means? That means higher gross margins. KeyBank is talking about $200 billion in data center sales for 2025, which is $60 billion more than the consensus that people are looking for NVIDIA. Data center investment is accelerating. JP Morgan put out an estimated customer mix for NVIDIA's BIS chips. Get this. Microsoft's taking 28%, Meta 14%, Amazon, Dell, and Supermicro each taking 10%, Google 7%. With customers like that, it's no wonder they can charge upwards of $35,000 per chip. Next, Melius's Ben Rice, by the way, Ben has been right the whole way on NVIDIA, says that money managers are actually underweight the company's stock, meaning they need to buy more if they want to kind of more accurately mirror the S&P 500. Do you think you want to show investors that you were underweight one of the greatest performing stocks of all time? So they've got the rest of the year to do some buying before their clients find out. I also think, by the way, that we're finally working through the churn that came from NVIDIA's 10-for-1 stock split. I told you that would take a while. It took a little longer than I thought. But if it were just NVIDIA, well, I'd be talking about something else right now. And that's why when I saw Bank of America had a cogent note on the Apple App Store this morning, now predicting 14% growth for Apple's fabulous service revenue stream, I recognize that we're getting a solid reason to feel optimistic even up here for Apple, something that could spur more price target bumps tomorrow. I also think, by the way, that the F1 movie, that's a blockbuster being put out by Apple Original Films, could be the first production to really move the needle for Apple TV Plus streaming services, a blockbuster that it costs less than going to the theater to take Apple Plus. I think it's going to mean something. Meta and Google needed some good news to justify their recent romps, and Goldman Sachs promptly gave it to us, saying that things are looking up for their digital advertising businesses. Digital brand advertising is very strong and will benefit from easier comparisons versus last year. Goldman also likes what it sees with the deployment and utilization of AI across the digital advertising space. Again, a justification for current and future prices. That's what the research departments are doing. Last night, we got this call from Arthur in New York. I don't know if you caught it. He was worried about the government maybe breaking up Amazon. No, I don't think that's likely. That's what I said. But right on time, we have a note from Jefferies giving us the sum of the parts valuation for Amazon. Apparently, it'd be worth 18% more than it is now if they broke it up, thanks to the strength of Amazon Web Services and Amazon advertising. And no, the stock is not going to be hit by all the stock that we learned later tonight Jeff Bezos sold. That's just something that people do, okay? Jefferies' Brent Thill points out that their cloud business is going gangbusters, accelerating from previous quarters. He says advertising is a stable 20% grower with optionality from Prime Video. The massive logistics spending for the pandemic years is behind them. Meanwhile, he notes that Amazon keeps gaining market share by reducing friction with the consumer, getting product to the well, you know how quickly it comes now. Incredibly, the stock's selling at a 25% discount to its 10-year average. Base case Amazon, $235. Stock's currently under $200. Incredible. Hey, Phil was busy last night. He also put out this survey of 40 U.S. chief investment officers on cloud spending. Can you imagine those guys must be more fun than a barrel of monkeys, don't you think? And they're opening their wallets big time. Apparently, cloud spending is biased to a double-digit increase, with AI being a material driver. Oh, and get this. Microsoft's Azure is edging out Amazon Web Services in the survey, 45 to 43%. Remember when Amazon had the ball to itself? I mean, it's incredible. Think about all these. These are the stocks that dominate the market. Today, I heard someone say that this is just like the concentration of companies that led the market in the year 2000, which of course means... Now, this is one time I'm happy to be a grizzled veteran. Age isn't worth much except when it comes to history. So I'm going to tell you that unlike the leaders of the dot-com bubble, these are insanely profitable companies that I'm talking about, and they keep innovating and keep giving you reasons to buy, and they are rational reasons. Sure, I don't want people to simply pay more for the same business over and over. That's called multiple expansion. Don't like it. These companies are pivoting constantly, giving you actual legitimate reasons to boost price targets. That wasn't the case at all back in 2000. We were constantly paying more for shares in companies that brought nothing new to the table until the quarter, and then they just issued disappointment after disappointment after disappointment. They were the opposite of these businesses. The bottom line, there are many things you can call these magnificent mega cap companies, but unlike 2000, ridiculously overvalued, ain't one of them. Dan in California. Dan.
Mr. Kramer, thank you very, very much for everything you do for the little guy.
Thanks, Dan. Thank you.
My question is regarding Celsius, and it has dropped considerably in the last 45 days. And the only thing that I can find out is that one of the people who owns 10% of the company sold $25 million worth of his stock. That's all I know, and I don't understand why it's dropped so more.
Well, there had been a decline in the growth rate, very subtle, in the last few weeks, and there was also a story about how their stuff was being heavily discounted at the club stocks, at the Costco kind of thing. And that's what's keeping it down. The numbers that came out this morning were more positive. I'm not giving up on Celsius. I think it's a very interesting story. And thank you for the kind words. Let's go to Mark in Washington. Mark.
Hey, Jim. Thanks for taking my call.
Of course,
I've been holding on to Eaton for the last 2 years and watched a great run up. Is it time to sell, or should I go longer?
No, you want to own Eaton. We put a very nice position on for the Charitable Trust, and we've been telling people, look, when you hear data center growth, Eaton should be one of the ways you played it. I know it is stalled here, but remember, it's not going to be one of the Sainted Seven. It happens to be a great industrial that I think is going to have a very good next couple of years. Barbara in New York. Barbara.
Hi, Jim.
Barbara.
I'd like to know what you think of Constellation, CEG.
Oh, Constellation Energy. Okay, we like Constellation Energy very much. That's nuclear. It's clean. It's what people want. I'll give you two for the Charitable Trusts. We own Constellation Brands, and we said yesterday we had to trim a little because we just didn't like the fact that they kept the wine and the spirits, but I'm liking both Constellation Energy and Constellation Brands. There you go. All right, now, look, there's a lot of things you can call these magnificent mega caps, but ridiculously overpriced, ain't one of them. They have money tonight. Tesla shares, I know you care about that, are electric of late, but could the rally continue? I'm going to give you my take. Then I'm going bargain hunting in the retail space, and revealing it's time to circle back to two stocks that I really like, and I'm not going to mention their names, Best Buy and Dick's. And roller coaster of profits, I'm breaking down what the merger between Cedar Fair and Six Flags means for you. So stay with Kramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Kramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
In case you missed it, Tesla's on fire again. In the past 4 weeks, the stock rallied 54%, with the company's market capitalization climbing from $544 billion, where a lot of people thought it was very expensive, to north of $836 billion. That is staggering. With today's 3.7% gain, it's now up for 10 consecutive sessions, people. In fact, when the stock finally bottomed back in April, it was down 44% for the year because it felt like everybody had given up on the American electric vehicle industry. But after its recent run, Tesla's now up more than 5% for the year. Those who shorted it down there, they've been crushed. So what the heck happened to get Tesla's stock behaving like the old self again? And more important, can the stock maintain its momentum? First off, Tesla started roaring when Elon Musk won approval for his enormous $56 billion pay package last month. I mean, there was a real feel that Musk might lose the vote. And, well, look, let's just say if he lost it, a lot of investors were very worried that he might end up devoting much less time to the company. That's an existential threat that was averted. No matter how you feel about Musk, if you're a Tesla shareholder, you want him working full-time at Tesla. So once he got his pay package last month, it got rid of a major source of uncertainty, and that indeed is what kicked off the monster run. Now, second, number two, we know the electric vehicle business isn't doing great for anybody, including Tesla. But Musk is a master showman, and he's apparently gotten his investors to look past the current state of the core business. Instead, he's directed their focus to Tesla's future initiatives, especially autonomous driving, robo-taxis, that's very big, and energy storage. He was already doing this back in April when Tesla reported first quarter results that fell short of expectations. But the stock soared in response as Musk talked about these new technologies, including a robo-taxi debut event on August 8th. I would call that to be a much anticipated event, but that's just too much of a cliche. Along the way, there have been some incredible wins, but they're incremental, but I think they're big, that make the future initiatives seem more plausible. Like when Tesla won approval to deploy its, quote, full self-driving system in China in the final days of April. I thought that was incredibly significant. So Musk got investors to focus more on what's to come rather than what's happening right now. And that contributed to the first portion of the stock's huge move. But that brings me to item number 3. It helps that Tesla's core business has finally started to stabilize. Now, last Tuesday, the company reported second quarter delivery and production numbers, and they actually surprised to the upside. Nearly 444,000 deliveries. Wall Street was only looking for 439,000. Hey, listen, we'll take it. Now, in a vacuum, that's not actually a great number. It represents a nearly 5% decline year over year. But everything's relative in this business. Not only was the deliveries number better than expected, it was also an improvement from the previous quarter, where deliveries were down 8.5%. In fact, when you look at the quarter-to-quarter comparisons, Tesla's deliveries were up 15%. At the same time, the second quarter vehicle production number was just 410,831 vehicles, and that was way below deliveries. Positive, because it means that Tesla won't have any inventory problem. Too much unsold merchandise means you need to start heavily discounting your product. By the way, Tesla doesn't discount. Fortunately, now that's off the table. Fourth, there was one more item in this second quarter update. Tesla deployed 9.4 gigawatts of energy storage products in the quarter. That's something Morgan Stanley auto analyst Adam Jonas called a show stealer. He was expecting barely more than half that. Remember, we have endless demand for electricity from all these AI-powered data centers, and companies want to use renewables for that energy. But wind and solar aren't reliable unless you got storage, which is where Tesla comes in. Finally, there's one more reason Tesla's been roaring, and I'm less excited about this one. Retail investors have fallen in love with the stock again. We've seen the meme stock cohort try to make a comeback. They attempted to resurrect GameStop back in the spring, and it didn't last. They got crushed by the pullback in crypto. Roaring Kitty tried to bull up Chewy, and that rally didn't even last a day. And by the way, I'm pro Chewy, but we like to remember at 19. And that's why I think many of the memesters have returned to their first love, which was Tesla. You can see it when you look at the volume in Tesla's options recently. That's where the action is, the options. The most aggressive home gamers have found their way to options over the past couple of years, especially very short-term options, even ones that expire in a day or less. Early last week, we learned that options traders have become the most bullish on Tesla that they've been in 3 years. Just yesterday, CNBC's Jason Gewirtz noted that Tesla's options volume was double the 10-day average. That is a tremendous insight most people missed. All that has really helped push the stock up from behind the scenes. So that's how we got here. What comes next? That's what matters, right? Honestly, who knows? The bulls are certainly in charge again. And given the way this thing's been trading, I think anyone who tries to short Tesla, you know what? I'm going to send out some funeral invitations beforehand to those who want to short it, just so they have them on hand. However, when I see what's been driving this rally, I got to worry a little bit about longevity. 10 straight days up. Tesla's got two big catalysts coming. They got the company reported its full second quarter earnings, 2 weeks. Then it holds that big robo-taxi event a month from now. Now, while we know Tesla beat the delivery estimates for the quarter last week, we'll only find out how they pulled it off when we get the complete results. I really don't want to see a significant drop in average selling prices, which would mean that Tesla was only able to hit its delivery targets with heavy discounting. That said, Tesla's conference calls are a wild card. Who knows what Musk will say and how investors will react? Although I have to admit, he's gotten a little bit more rational lately. Even if we get a drop in average selling prices, Musk could say that the Cybertruck's selling great, and the stock could rally in response to that. As long as the shareholder base is on board, the guy can pull a rabbit out of a hat. We know that. He's David Blaine, okay? Given that Wall Street's less concerned about the current core business and more focused on the future, I think the Robotaxi showcase on August 8th might be the more important event. I hope Musk and company can deliver a plausible plan for how Tesla can build a scaled robotaxi network in a world where full self-driving is highly regulated and only it could become big, especially in China. In the end, it's a big event that could go either way. So if it fails to impress, I expect the stock to get hit. But remember, I am focused on self-driving in China, which I think can be very big. Here's the bottom line. It's nice to see Tesla running again, and the last thing I'd recommend is to try to short the stock. However, I worry about how long the rally can last. I say we defer judgment. Let's wait until we see the full quarter in a couple of weeks and then the big robotaxi event in a month. Until then, I'm not ready to give Tesla my endorsement at these new, much higher levels, especially when I said I liked it much lower not that long ago. Mad Money is back after the break.
Coming up, a Best Buy, 2 retail winners adjusting in the online age. Next.
There are a few things more frustrating than missing out on a major run in a stock that you liked but didn't actually buy because you were too gun-shy to pull the trigger. Often we tell ourselves that we'll buy these winners on a pullback, except when they start coming down. People tend to panic and figure they're going lower for a very good reason. They don't want to get involved. And that's why I always stress that sell-offs in high-quality stocks are actual buying opportunities, even if it might not feel that way at the time. Luckily, we're getting a couple of these entry points in some terrific stores right now, and I don't want you to miss them. First, there's Best Buy, BBY, the iconic electronics retailer. It's been a nice winner for my child trust. Most of the gains here came at the end of May when the stock jumped more than 13% after Best Buy reported a phenomenal quarter. It continued to roar through mid-June, but since then it's pulled back hard. And although the stock's already started rebounding from its lows, you know what? I think it's still a good entry point. Why? because there was a lot to like in that quarter. Even though sales came in later than expected, the company earned $1.20 per share. Analysts were looking for $1.07. That's a first beat I can recall in a long time. The source of Best Buy strength, they're generating more high-margin service revenue, which was enough to offset any concerns about lagging hardware sales. But the main reason Best Buy rallied like crazy was management's extremely positive conference call commentary. Even though the company had weaker numbers in struggling areas like appliances, everyone knows appliances are tough, they had terrific gains in services and laptops, which make up more of the business. On the call, CEO Corey Barry explained, and I'm going to quote here, "We have seen early signs of improvement as year-over-year comparable sales for laptops turned slightly positive in the fourth quarter, and that trend continued in Q1, end quote. And why should we expect this trend to continue? Best Buy is confident that this upcoming PC upgrade cycle, fueled by new models with built-in AI technology, will lure in tons of traffic. Sure, you can buy a computer online like anything else, but these new PCs, they're big-ticket items. When you're spending $1,000 or more on a machine, well, you're more likely to go to an actual store for some hands-on testing and maybe some input from sales associates. Plus, when it comes to the new AI-powered PCs, 40% of them will be offered exclusively at Best Buy. Very smart move because unique merchandise will bring people into the stores. Now, all that said, there was some concern regarding the health of the consumer to purchase such expensive products, a fact that management didn't shy away from on the call at all. And they acknowledged that the electronics space has suffered in the years since the pandemic because so much demand got pulled forward during COVID, the home office issue. But when there's innovation, Best Buy's adamant that the customers come right back. For example, when they launched the line of iPads from Apple with the new M4 chips, management says that they saw these devices, I'm going to quote, pretty much immediately stimulate some really interesting demand, end quote. And these new iPads are already boosting their sales in the current quarter. How about the guidance? Well, Best Buy left the full-year forecast unchanged. They did mention that their adjusted operating profit should come in towards the upper end of the projected range. Hey, to me, that sounds like a guide up. So Best Buy reported at the end of May. The stock caught fire, ultimately rallying all the way to 93 and change at its peak. Since then, though, the stock's been clobbered. It fell to $81 last Tuesday, where, by the way, we told members of the CNBC Investing Club to buy more, and I bought stock from a charitable trust. Clearly, the market agrees, because Best Buy's now rebounded to 86 and change. Still, that's a solid discount versus where it was in mid-June, and I think it remains a strong buying opportunity. I picked some up right here. As we've been telling members of the Investing Club, we want to get in ahead of the expected inflection in same-store sales growth later this year, as we wait for the AI-driven innovation replacement cycle to turn. And remember, I'm a big believer in it. Oh, by the way, it doesn't hurt that the shares are paying you a hefty 4.35% dividend yield while we wait. Next up, in the last couple of weeks, we have seen a big pullback in Dick's Sporting Goods, another specialty retailer that reported a spectacular quarter at the end of May. Substantial same-store sales beat, substantial earnings beat, great guidance. No wonder the stock jumped nearly 16% the next day. Lots of impressive aspects to this Dick's quarter. First of all, they put up 5.3% same-store sales growth, with roughly half of that coming from higher transactions and half coming from higher prices. Clearly, management's doing just a great job of bringing in new customers, and these customers don't have a problem spending big as long as it relates to a healthy and active lifestyle. That seems to be the area that people still spend on, that and big travel. At the same time, Dick's has this brilliant house of sport concept. These are mega-sized, I don't know if you've been one, you got to go to one, mega-sized locations built around exciting in-store experiences. I love the one I go to. It's a lot easier to figure out which baseball bat your kid needs when there's a batting cage on site. Dick's also has a golf kicker with its Golf Galaxy Performance Centers. Oh, and let's not forget something that I wish I had had. Oh, my God, this Game Changer app. This is a state-of-the-art live streaming, scheduling, scorekeeping, and communications platform for amateur sports. This app gives parents the ability to keep track of their kids' sporting events, even when they can't be there in person. Oh, I wish I had this thing when my daughters were little, because I was a workaholic and, by my own admission, missed way too many important games. I think this is a hidden, very valuable asset. In some tapes, meaning stock market tapes, that are more forgiving, you know what? I think they could IPO this product for $1 billion. Whatever the reason may be, it's hard to put a price on those memories and easy to see parents prioritizing that kind of spending. So far, it seems like Game Changer is a real hit. On the call, management told us that the app now has over 5 million unique users who spend roughly 30 minutes per day on the platform. That is unbelievable. I'm telling you, this thing's for real. Going forward, Dick's also sounded pretty darn excited about new products they can sell alongside the upcoming Paris Olympics. Available on the NBC Universal family of networks on Peacock. There, okay, Peacock or the network. But I should mention, they're on the network and also on Peacock. There are a bunch of companies rolling out breakthrough products alongside the Olympics, including the beleaguered Nike. Maybe that'll help them, or I don't know. Either way, it's good news for DAX. Now, just as important, management raised their full-year outlook for same-store sales and even raised their earnings per share forecast by 50 cents at the midpoint, greater than the 34-cent earnings beat that DICK'S had just reported. Very encouraging. I love to see a company raise guidance after only the first quarter. It means business is going much better than anybody expected, even 3 months before. All right, but what about the stock? Now, DICK'S stock initially jumped from $195 to $226 on the day it reported, eventually peaking at $234 and change just 3 weeks ago. Since then, listen to this, its stock has sold off hard, pulling back to just under 201 today. In other words, you're practically getting that amazing last quarter for free. Even if you missed the initial run, you are getting another chance to buy this one at a terrific price. Here's the bottom line. Best Buy and DICK'S Sporting Goods both reported much better than expected quarters this past spring, but now Best Buy's down almost 8% from its post-earnings highs, and DICK'S has fallen 14%. To me, I don't know. These look like terrific opportunities. You know what? Let's go to Juan in Florida. Juan.
Hi, Jim. Thank you for taking my call.
Of course.
Thank you for everything you do for all small investors.
Thank you, Juan. Thank you. That is the essence of what we try to do on Mad Money. I'm sorry, I didn't mean to interrupt, but that is the essence. Go ahead.
I watch your show every day. You have been very helpful.
Thank you.
I have a question on Cisco. I have a position at $50 per share, and the stock is not showing any signs of life. What do you recommend? Buy, hold, or sell?
Oh, jeez. Okay. Look, I think you got to hold it. We do need to see a big quarter from them. We just have to see a big quarter from them. And I say the reason why I'm saying hold is because you got 3.5% yield, and that still works pretty good. But it's been a tough run. I do want Chuck Robbins to come on. He always tells us it is. But I can't account and then selling the stock down here with a 3.5% yield. Can we go to John in Connecticut, please, John?
Yes, hi. I own
John.
Intel, and it's not moved in many years now. And should I keep it or dump it?
I think Intel's just had a nice move, actually. I want you to sell half tomorrow and let the rest run, just in case we see that there'd be a relief rally continues. But I don't think that you should be in the stock because it's bouncing. It's what I call a dead cat bounce. No offense. My daughter's a cat sitter. I don't want anyone getting mad at me that I use that phrase. But it did feel like it had a dead cat bounce feel to it. All right. Both DICK'S Sporting Goods and Best Buy reported better than expected quarters, and the recent declines of both names, to me, that's looking like a real buying opportunity. Bring it in, much more Mad Money in. Two amusement park giants just merged. So are investors of the new Six Flags Entertainment in for a wild ride? Ha ha! Buckle your seatbelts, cowboy. Kramericans, get ready. I'm going to give you my take. Then in mythology, Helen of Troy's beauty was considered the cause of the Trojan War. But the stock Helen of Troy looks anything but beautiful today. I'll reveal what its whopping 27% drop means for the overall market. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Kramer. If you were planning to hit up an amusement park this summer, you should know that last week, two of the largest players in the space, Cedar Fair and Six Flags, completed a merger of equals. The combined company is now known as Six Flags Entertainment, although they wisely stuck with Cedar Fair's old ticker, FUN. This deal was announced last November. In full disclosure, I really never gave the deal a chance because I wasn't sure it would even happen. I just didn't see the deal getting past the Biden administration's notoriously strict antitrust regulators, who seem to believe that all mergers are anti-competitive. Given that Cedar Fair and Six Flags were in the same line of business, I thought the FTC or Justice would actually try to block it. But apart from a standard request for additional information earlier this year, the regulators didn't lift a finger, and the merger ended up closing very quickly. It was all finished by July 1, and shares of the new company started trading exactly 1 week ago. Why we needed to get this piece done. Clearly, Wall Street wasn't too optimistic about this deal getting past the regulators either, because both stocks did next to nothing for months after the announcement. Then they caught fire last month as we realized, hey, this merger is going to happen. Six Flags was trading in the mid-30s before the announcement. Last November, now it's at 55. And I wouldn't be surprised if it's got more room to run. Wow. What makes me feel so confident about this one? Let me walk you through it, starting with some housekeeping notes so you understand exactly what's going on. First, while there's no such thing as a true merger of equals, this is about as close as it gets. It was an all-stock transaction where former Cedar Fair investors got 51% of the combined company and former Six Flags investors got 49%. Key management roles were divvied up like this. Six Flags CEO Salim Basoul became executive chairman of combined company, with Cedar Fair CEO Richard Zimmerman keeping that position for the new Six Flags Entertainment. The CFO of Cedar Fair is now the CFO of the combined business, and the former CFO of Six Flags has become the chief integration officer of the combined company. The new board has 12 members, 6 from Cedar Fair and 6 from Six Flags. Now, the combined business has 42 properties across North America, 27 amusement parks, 15 water parks, 9 hotels or resorts, 7 campgrounds, 2 safari or animal experiences, 2 sports facilities, 3 marinas attached to some of their largest properties. Wow. The reason I like this deal is that the old Cedar Fair was way too concentrated in the Midwest, while the old Six Flags was too dependent on the South. The combined Six Flags Entertainment, however, gets no more than 30% of its business from any single geographic region. This is one great deal. When you look at it, take a close look at this thing. You see these businesses are quite complementary. While Six Flags had more properties than Cedar Fair had higher attendance and revenue. Both companies had almost identical cash flow. Cedar Fair had higher overall profits, but Six Flags had better profit margins. Of the two companies, Cedar Fair had the better balance sheet. But management says the combined business will be stronger than the sum of its parts. I believe them. First, fundamentally, they say the combined business can offer a more diversified guest experience with amusement parks, water parks, resorts, campgrounds, and safaris all in the mix. This industry, by the way, loves to sell season passes, and the merger should give Six Flags Entertainment a major boost here because season pass holders will have access to many, many more locations, especially now that the company plans to offer a combined loyalty program with additional parks. On a more basic level, the merger means that Six Flags and Cedar Fair can combine their best practices, especially on the technology front, resulting in a better guest experience all around. And that's why I'm thrilled that the CEO and CFO both came from Cedar Fair, because Cedar Fair was generally regarded as the better operator of the two. On the other hand, Six Flags brings to the combined business some excellent intellectual property rights, including Looney Tunes, Peanuts, and DC Comics. They can roll out Batman the Ride everywhere now. How about the financials? At the same time of the deal announcement, both companies said they expected the deal would be additive to earnings within the first 12 months. They told us they'd identified $120 million of potential cost savings to be realized within the first 2 years. And they also believe that the improvements to the guest experience will increase earnings before interest, taxes, depreciation, and amortization by an additional $80 million within 3 years of the closing. That's not that much, but it's still better than nothing. I was actually hoping that was the one line that I felt should have been higher. If you believe these projections, then the combined business should have ultimately had $3.4 billion in revenue, $1.2 billion of adjusted EBITDA, and over $800 million of free cash flow. It will have a cleaner balance sheet than Cedar Fair or Six Flags had on their own, although management says it can get its leverage ratio down further from 3.7 to 3 within the next 2 years. Not conservative, but okay. We don't yet know what the dividend will look like, as management has said that it's prioritizing paying down debt initially, but hopefully dividends and buybacks can be added to the mix down the line. But remember when Cedar Fair had that great yield we used to talk about all the time? Given those numbers, the stock doesn't seem too expensive to me, even after the recent run. The analysts are looking for Six Flags Entertainment to earn $3.17 per share this year, according to $3.90 per share next year. That means the stock sells for 17.5 times this year, roughly 14 times next year. Now, look, that's so much below the average stock in the S&P. I like that. Plus, I think it works thematically in this market. We know spending on travel and leisure hasn't really gone away. Sunday was the biggest number ever, according to the TSA, although many consumers are more value-oriented, going for bargain vacations like cruises. To me, Six Flags fits right in there as a bargain orientation. It's a trade-down theme park play, the place to go if you don't want to shell out for a flight to Disney World or those higher prices for rides. Last Tuesday, after the deal officially closed, analysts at Oppenheimer raised their price target for Six Flags from $49 to $67, saying they think Cedar Fair's terrific executives can get a lot more mileage out of Six Flags assets. Plus, the old Cedar Fair part of the business already had a strong start to the season pass selling season, and so far we've had nice summer weather. And Oppenheimer is not alone in its bullishness. All 6 analysts that cover the stock have a buy or equivalent rating on it. Average price target just above 61, up more than 10% from where it's currently trading. What can I say? When the consensus is right, it's right. Bottom line, add me to the list of Six Flags Entertainment bulls. Like I said before, I'm pretty surprised that the regulators allowed this one to go through because they're skeptical of all mergers, especially ones that will be great for business. Now that the regulators have let it happen, though, I think you've got a terrific investment. Sure, the stock's run substantially over the past month, but I bet it's got more upside. Mad Money is back after the break.
Coming up, pop open those umbrellas and tee up your toughest questions. Kramer takes on all comers in the lightning round. Next.
It is time. It's time for the light round. That's where we're at for all those. Let me say bye. So don't know the stock question ahead of time. My staff appears to play me. Play this out. And then the lightning round is over. Are you ready, Ski Dad? Go to the lightning round. Let's start with Bill in Massachusetts. Bill.
Hey, Jimmy Jams, how are you this evening?
I'm having a dynamite time. I got my buddies out here on the floor, and we're enjoying ourselves. What's going on?
Fantastic. I trimmed my Meta and my Eli Lilly. I'm looking to strengthen my position in some banking. I'm thinking of Morgan Stanley.
No, Morgan Stanley's moved too much. Now, we own it for the Chapel Trust. Nothing against Morgan Stanley or Ted Pick or all the good people there. But at 102, we don't want to buy anymore. The only one that I would count in that group that I would still buy is Wells Fargo with Charlie Sharp. That would be the stock to buy. Now we're going to go to Mo in New Jersey. Mo.
Jim, booyah!
Thanks.
In Jersey. How you doing?
I'm doing okay. How about you, partner?
Good. So I just started investing a little bit on my own, and I'm interested in what you think about Reddit because it seems.
I want to buy Reddit. I think Reddit. I'm going to throw Reddit and Pinterest in. These are two stocks that people don't realize. These are like when you're going up. It's just 3, 6, and 10 in Philly. Suddenly 29 starts playing. 29 gets in, starts getting a little extra money. This is like the new channels, and both Pinterest and Reddit are new channels that are working. Let's go to Frank in New York. Frank.
Yeah, Jim, Frank from Pelham. Thanks for taking my call, and thanks for your extreme integrity, Jim.
I'm doing my best. Thank you. That's what matters. Thank you.
Over the last year, uranium has come into its own, and a lot of nuclear is becoming a lot more popular. And when the uranium comes out of the ground, if I'm saying this right, it has to be enriched before you can use it. And one of the few companies, if only maybe the only company, which would put it in the catbird seat, is Centrus Energy. What do you think?
Okay, now I understand. I am so pro-nuke that I'm willing to speculate on a nuke, and that is one that I am fine with speculating. I think it's good. I understand it's a long-term situation, but I think it is good. And now we're going to go to Sean in California. Sean.
Hey, Jim, how you doing? You buy your stake in the Eagles yet?
You know what? I've been trying to figure out whether I should keep my 10% stake. That means 10% cheesesteak that I bought at Gino's, okay?
That's a good one. Hey, I'm calling about a company that's growing on the top and bottom line, and they just instituted a dividend. It's reminding me of the Lilu case study on Timberland from years ago. It's Supergroup, SGHC.
You know, I liked Supergroup when it started, and, I kept thinking that, it's a great entertainment and gambling company. I'm not going to back away, but it's done nothing. Candidly, it's done nothing, and I don't understand the dividend. But, yeah, I mean, that was one we had Eric Grubman on, and I think that Eric is a guy I revere, great integrity, smart. I'm going to say I think that's a smart move by you. Let's go to David in Florida. David.
Jimmy C. Booyah.
Yo, what's shaking, partner?
So casino stocks have been falling for the past couple of months, even though they showed stellar earnings. Casinos are packed. When is the cream of the crop? Good time to buy? What do you think?
Okay, so I think it is, but I got to tell you, anything connected with China, whether it be Nike, whether it be Starbucks, whether it be Wynn, they are considered to be losers by the market, and I can't change that perception until we start seeing things get better. So the answer is yes, I want to buy it. No, I don't think you're going to make a lot of money within the near term. Let's go to Alex in Louisiana, please. Alex.
Booyah, Kramer. Hey, as we all know, cybersecurity is crucial for the national security and businesses, especially in this AI-driven era. My question concerns SentinelOne. They face tough competition from CrowdStrike, known for strong leadership and brand recognition, and Palo Alto Networks, offering extensive network, endpoint, and cloud security. I believe SentinelOne is trading at a significant discount with a killer price to cash flow ratio.
It is, but it deserves the discount because it's missed the quarterly estimates. That's what makes me worried about it. So I'm not going to say that that's wrong. I'm going to say that that stock is correctly priced. And that, ladies and gentlemen, the conclusion of the Lightning Round!
The Lightning Round is sponsored by Charles Schwab. Coming up, don't touch that dial. Kramer has more on this market you won't want to miss. Next.
When a stock declines nearly 28% in a single session, you got to take notice. When it's a consumer packaged goods company like Helen of Troy with its pastiche of brands ranging from OXO kitchen products, Hydro Flask, Dry Bar, Revlon Cosmetics, Braun household appliances, and Osprey outdoor gear, all pretty stable business lines, you know there's something very, very wrong. I want to put aside the company's specific issues to focus on the big takeaways from Helen of Troy's hideous earnings miss. Historically, I've actually liked this stock for its consistency and its constant efforts to upgrade its portfolio of brands. Helen of Troy's only missed earnings estimates twice in 5 years, which is what makes this massive shortfall so extraordinary. What gives? Well, I want to quote CEO Noelle Joffrey from her conference call. First, she says, quote, "The macro environment and the health of the consumers and retailers has worsened. Consumers are even more financially stretched and are even further prioritizing essentials over discretionary items," end quote. She then explains that there has been, quote, "an unexpected slowdown in the global outdoor category," end quote, "more pressure on the specialty beauty channel and mass beauty channel, especially in beauty tools under $100, end quote. And then, get this, quote, "more discretionary household items like dry food storage continue to trend down. We've heard broadly from mass retail that traffic overall is slower throughout the country and promotional pressure is increasing," end quote. Ouch. Now, it's true that Helen of Troy's brands aren't necessarily the best in their category, but this kind of weakness is new and it's sudden. It's telling me that we've had a weaker spring than many realize. Put simply, you don't need to buy anything that Helen of Troy makes. You can put it all off. In every category, these numbers would indicate that's exactly what's happened. Remember, for the past couple of months, I've been telling you about brown shoots, my term for nascent slowdowns across the economy that will necessitate the Fed to cut interest rates in the fall. We saw brown shoots in lower steel and lumber prices. We saw them in Pool Corp, which is struggling to sell its swimming pool-related wares. We saw them declining sales at Nike and at Starbucks, companies that raised prices by too much during the last 5 years. We've seen it in weaker dining out, including Quick Serve. And we know the consumer packaged goods companies that have raised price aggressively are now in a pickle. They don't want to cut price, but they may have no choice if they want to stay competitive. Otherwise, big retailers like Walmart and Costco will do it for them. Yes, those two companies have that kind of power. They can drop your product or even go against you with their house brands. Costco's Kirkland signature brand is the unique premium house brand, and Costco will unhesitatingly use it against you if you don't lower prices for your goods in their stores. That, or they'll eliminate your wares entirely. Costco is the greatest inflation fighter of our generation. Now, when Fed Chief Jay Powell spoke to the Senate today, his testimony was considered to be pretty dovish. Maybe he saw this slowdown unfolding. Maybe he's laying the groundwork for September rate cut. News like the shortfall from Helen of Troy are in-your-face warnings that the consumer isn't just being frugal and stingy. The consumer's choosing to defer or avoid buying anything non-essential. Right now, the market's handling Helen of Troy as if it doesn't matter. Hey, look, it's not a mega-cap tech name, so who cares? Maybe investors think that because America's had the biggest travel day in history just last Sunday, that people simply aren't spending money on their hair care, hiking, kitchen products, because they're spending on airline tickets and hotel rooms. That's one way to look at it. But I think we have to start wondering if the decline of the consumer is accelerating. Maybe June, for example, turns out to be much weaker than we thought. Maybe this is simply the dark side of the soft landing. One thing we don't want, though, is some situation where we need to start foaming the runway before the plane lands. I've been in one of those landings. We all got out in one piece, but I don't want to experience another one if it can be avoided. And as long as things keep deteriorating, Jay Powell will have the wiggle room to engineer the soft landings through a couple of rate cuts this year. And increasingly, it looks like he's going to have to start in September. I like to say there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Kramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Kramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.